The Reserve Bank's Monetary Policy Committee will this afternoon announce its final decision of the year on interest rates. The meeting follows higher than expected consumer price inflation in October, and the bank will have to take this into consideration. CPI climbed again to 5.9% in October. That's from 5.4% in September. Experts say the Reserve Bank will likely keep the repo rate unchanged.
Even though this inflation figure turned out to be higher than expected, they will look beyond that and will leave interest rates unchanged. But what it does show is that there is a danger in being overly optimistic about interest rates coming down anytime soon. There is now going to be a fear that they will raise the interest rates. I don't believe that will be the case, but at the same time, it is a warning that one must not be overly optimistic about interest rates coming down too fast next year.
All right, let's stay on this topic. Christie Viljoen, an economist at PwC, joins me. Christie, thank you so much for your time on SABC News this afternoon. Just take us through traditionally what the MPC takes into account when it makes its decision on interest rates.
So over the 2 or 3 days that they meet, they look at a variety of economic indicators and also specifically economic growth forecasts, inflation forecasts, etc. They feed all of that into a view on where inflation is going and the general economy, and then they decide what the appropriate level of interest rate should be. So the most recent inflation number, it's always something they consider, but we have to keep in mind that the Reserve Bank makes interest rate decisions based on their forecast. They look 2-3 years ahead on where inflation is going. So that is for them the key, what the forecasts look like.
Mm-hmm. Christie, we know that at 5.9%, that inflation rate is towards the upper band of the Reserve Bank's target of 3 to 6%. And then they use monetary policy instruments to try and cool inflation. I know that you've spoken about the forecast and how that makes a decision, but does any of that 5.9% figure then give an indication of what may be announced at 3 p.m. today?
Well, I think up until a few days ago, there was a general expectation that interest rates would be on hold. Mm-hmm. We've had some good signals in terms of the stronger rand, lower oil prices. We've also seen probably an end to interest rate increases in many of the major economies. So all of those told us probably no change to lending rates this week. And then we got the surprise number yesterday, which the Reserve Bank will have to look at. It is their most recent number before they then do their forecasts. And in any kind of economic model, this most recent number is quite important. So the risk is that the expectation of no change could be a little bit outdated, and it could be that they might make a small upward adjustment. If they do, it'll be 25 basis points. We are beyond the line of where it would be 50. So I still personally think that most likely no change. If it is different, it's going to be a small upward adjustment. But most economists would then also tell you that would most likely be the last one. Mm-hmm. Everyone's now talking about what's next, and what's next is actually lending rates coming down from next year.
When you say that the lending rates coming down, maybe a more dovish tone coming from our central bank, practically, would that be in the beginning of next year? And what signals would there need to be in order to ensure that the MPC says, okay, right, it's time to give consumers some relief?
So what they're looking for is that in those forecasts, they can see that inflation is moving sustainably back into the target range, mm-hmm. and ideally towards that 4.5% that they are favoring at this stage. So as soon as we get to a point next year where the forecasts look that favorable, they can start cutting interest rates. And I think that at the moment, it's probably going to be around the middle of next year, which I think is the start of good news for everybody that's got debts that they have to pay, mortgages, vehicle loans, etc. But it still depends on the month-on-month inflation data coming out. Because as we saw this month, surprisingly, it was much higher than expected. So the Reserve Bank then talks about the upside risk of inflation. So we need to see in the next few months the upside risk, what's happening. And the next decision that they make after this week is in January. Then we'll have more data. We can then maybe have a better view on when interest rates would actually start coming down.
Yeah, our inflation and what happens in South Africa doesn't happen in isolation. There's lots of global and local factors leading to that. Just take me through some of those and what influences those increases that we see.
Well, if we think, for example, on fuel prices, which is a big component of the pressure that we see in inflation, we know that there's two big factors determining that: the international oil price and the rand exchange rate. And both of them are largely determined outside our control. The rand is very much traded internationally. Oil prices are determined in financial markets. So those are two of the big things that we need to look out for. And I think the big risk heading into 2024 is whether some of the big conflict situations that we have, for example, in the Middle East, in Eastern Europe, for example, if any of those threaten oil production and oil exports in some of the major producers, we could see pressure on oil prices and pressure on the rand, which would then have a negative impact on our inflation numbers. So that's just one of the big international things where we as South Africans, we don't have control whatsoever on those. But we have to take what those numbers are saying, and it impacts our inflation in the end.
All right, Christie Viljoen, an economist at PwC. Thanks so much for your time and insight on SABC News this afternoon.